Namaskar. Good evening to everyone. Once again, welcome to each one of you in this second day of the IND-AS series. And one of the dynamic speakers, CA Hemant Arora ji with us. So welcome to you, Hemant bhai.
Thank you, sir. Thank
Hemant
you.
ji is also associated with our team for addressing this IND-AS since starting 2006-7, 16-17.
60.
So I must congratulate and thanks to Hemant ji for giving your precious time as always. And one of the important topic which he is going to cover IND-AS 115, revenue from contact with customer. This is one of the key uh, ac- key IND-AS where we are learning how to recognize the income, how to book the revenue. So you will definitely learn a lot by his address. Before starting on the technical topic, I would like to brief about Hemant sir. Hemant ji is a chartered accountant by profession with having more than 20 years of experience in the finance and account. Currently, he is serving as a technical director CFO advisory at KPMG in India. He is specialized in IFRS, IND-AS, financial reporting, financial decision making for non-finance professionals, and he is also trainer at various platform. So definitely, it is also going to be a good learning session by him. So, but friends, we have shared the yesterday video recording and presentation would be shared by today tonight. So, if you have anything you want to communicate, you can post me. You can text me at my WhatsApp number. You all have. So now I request Hemanji to take up the technical session. Over to you, sir.
Thank you. Thank you, Sumit. Thanks for the invitation
Thank you.
and congratulations for this initiative.
Thank you.
Good evening. Good evening, all of you. I welcome to all of you. And directly, we are jumping to the technical topic IND-AS 115. Sumit, can I share my screen?
Yes, sir. Yes, sir. Yes, sir. It is allowing, not allowing.
Yes, it is.
It is.
I'm trying to do it.
Okay. 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 Okay.
This PPT is visible.
Yes, sir. Yes.
So our topic is IND-AS 115, as you can see on the screen. And yes, there is short disclaimer also. We are going to take names of some of the companies. We are going to use some examples, some case studies, etc. And all should be considered as academic exercise. What we are going to discuss, uh, this IND-AS 115 is a new topic, and this is applicable only from 1st April 2018. It has brought lot of changes. So Sumiji, we are comfortable with both Hindi, English, na?
Yes. Yes. Very well, sir. Very. Hindi
Great,
and English
great,
would be workable.
great. So it's a new standard 1st April 2018. What was there before 2018? There were so many things. There were two accounting standards which were dealing with revenue, and there were four interpretations. And in India, those were part of appendix. If you look at the screen, for construction contract, we were having different standard in IND-AS 11. For normal revenue recognition, IND-AS 18 was there. For barter advertising contract, appendix A was there. Transfer of asset from customer, separate appendix. Customer loyalty program, separate appendix. Real estate accounting, separate appendix. And one more thing, no need to memorize anything. Today's topic is a very big topic. That's why we have only one topic for full session. So many things will come. Some of the things will be known to you. And if something new is coming, no need to memorize it. I will share this PPT with Sumit sir, and then you can refer it in your free time. So six things were there earlier, and now we have only one thing, which is IND-AS 115. And you all know it is based on IFRS. In IFRS, we have IFRS 15. almost similar. There is only one small insignificant difference is there, but 99.99% you can say IFRS 15 and Indian Accounting Standard 115 are similar. So we'll talk about scope and objectives. And if you know, this standard has given us 5 steps model for revenue recognition. We'll also talk about contract cost. Actually, this is a revenue standard, but to some extent, it talks about contract cost also. And then it is giving us some additional guidance regarding how to do accounting when we are modifying the contract, when to do accounting when we are selling with the right of return arrangement. For example, you are buying something from Flipkart and they give you the option to return within 15 days. Now, can they recognize revenue on day one or shall they wait for 15 days? So this standard will help us. Warranty. There is standard warranty, there is extended warranty. You are buying a new car, Maruti gives you standard warranty. Which accounting standard we should apply? And then you have option to buy extended warranty. Will that be part of revenue? This standard will help us. Customer loyalty program. You are traveling by Air India and then you are accumulating points. Now, what would be the accounting treatment of those points? This standard will help us. Principal versus agent. Make my trip. When you are booking ticket through Make My Trip, you are paying full price to Make My Trip, out of which they deduct their commission and rest of the amount they pay to the airline company. What would be their revenue, gross or net? Bill and hold. You are buying something, but you are requesting to the supplier that I don't want delivery right now. Now, what supplier should do? When supplier should recognize revenue? When he is billing the document or when he's supplying the goods? And then consignment arrangement. Maruti is supplying goods to dealers. When they should recognize revenue? On delivery or when the dealer is selling to the third party? And this standard is also talking about disclosure also. Actually, this is a complete standard, RMPD standard. This standard deals with recognition, measurement, presentation, disclosure. Almost many standard deals with RMPD, but there are few standards which deals only with one or two things. For example, if you talk about IES 1 or IND-AS 1, it deals only with presentation. If you talk about IND-AS 108, it deals only with disclosure. If you talk about IND-AS 24, it deals only with related party disclosure. But IND-AS 115, it is a complete counting standard. You know why this standard is important? Why new change has come? Because there were some limitations in the old accounting standard. What was happening earlier? Companies were taking loan, but they were recognizing the same as revenue. Companies were inflating revenues. Companies were selling with the option to get it back, and they were recognizing revenue, while ultimately they are getting their goods back instead of getting the cash. They were inflating revenues. It means that was not actual sales, but they were recognizing revenue. Real estate companies, what they were doing, they were recognizing revenue over the period of time. DLF was doing it. Many real estate companies were doing it. I'm not saying they were doing something wrong. That was what was there in the old accounting standard, you know. In old accounting standard, for example, you booked a flat with DLF. You paid 10% payment and then construction link payment you will pay. They were also recognizing revenue based on construction over the period of time by using percentage of completion method. But now in many of the cases, they have stopped using percentage of completion method. Now what they are doing, they are recognizing revenue once the project is handed over, once the project is complete. So this is a big change for real estate companies. And similarly, there is impact on some other companies also where they deferred the revenue recognition. It means instead of recognizing revenue now, they are recognizing revenue at a later stage. So this standard has inbuilt checks and balances. If you are auditors and if you apply this standard seriously, then chances are very low that companies can misuse the revenue recognition counting policy. If you are working in the company and your role is to finalize financial statements, and then if you apply this standard seriously, you would end up recognizing 100% fair revenue. So that is what this standard has in terms of capability. In scope, this standard deals with all contract with customers in the ordinary course of business. IND-AS 115 is applicable only to the core income, which is our bread and butter, which is our normal operating activity. This standard is not for other income. If you are generating interest income, then you will be applying IND-AS 109, not this standard. Even, even if you are a bank, you are earning interest income, you will be applying IND-AS 109. You are generating rental income. For rental income, you have separate standard IND-AS 116. Even if it is your business to generate rental income, then also you will be applying IND-AS 116. Dividend income, IND-AS 109. So this standard deals with the revenue from goods or services in the ordinary course of business. And the more important thing is that your revenue is the amount to which you are entitled to. So your entitlement is key. This word is very important. You are selling something. If you are entitled to get your money, then only you can recognize revenue. We'll understand everything with the help of examples. Some more examples are appearing on the screen. You are Maruti. You can apply this standard. You are Minda, selling auto parts. You can apply this standard. You are Yamaha, selling bikes. You can apply this standard. You are service provider, IT company. You can apply this standard. IT support, repair, consultancy, outsourcing. This standard is for you. You are into construction contract. You are L&T. You are Brookfield. You are into EPC contract. This standard is for you. You are providing licenses or intellectual properties, software, brand use, technology right. This standard can be applied. Franchise, McDonald's, Pizza Hut, telecom, Airtel, Vodafone Idea, real estate. This standard is for you. Hospitality, JW Marriott, you can apply this standard. E-commerce, Flipkart, Amazon, you can apply this standard. Here, important is 5 steps model. They have single revenue recognition criteria. Earlier, when IND-AS 115 was not there, there were 6 things. It means 6 different revenue recognition criteria. But now for everything, we have single one revenue recognition criteria, which is based on 5 steps model. You are selling for cash, this standard will be applicable. If you are selling for non-cash consideration, you are selling something, barter exchange, then also this standard will be applicable. To media houses, they exchange their services. They sell their slots. Times of India is selling to Hindustan Times, and Hindustan Times is selling to Times of India. Can they apply this standard? Yes. Customer loyalty program, we can apply this standard. Even consideration payable to customers. Normally, we get money from customer, but there may be a situation where we are liable to pay to the customer. Then also this standard will be applicable. For example, payback. You are buying iPhone. You purchase iPhone 17. 17 is the latest or 16 is the latest. And then Apple is saying that you will get certain cash back. You paid 80,000 rupees to the company, and company is saying that you will receive 3,000 as cash back. Now my revenue should be 80,000 or 77,000. This standard is saying your revenue will be 77,000 because your entitlement is only 77. Now you received 80, but out of 80, 3,000 is cash back you are going to. It is 3,000 is your liability. So your revenue is net of this cash back. There are certain things which are not within the scope of this standard. This scope out item, scope exclusion, this slide is applicable to almost all standards because one standard cannot deal with everything, like lease contract. This is important. We discussed that revenue is in the ordinary course of business. It means whatever I am doing in the ordinary course of business, I should apply IND-AS 115, but there is exception, lease. Even if it is your business to give property on rent, like DLF or RMG EcoWorld in Bangalore, it is their business to give property on rent. The rental income is not under IND-AS 115. Rental income is specifically covered under IND-AS 116 because we have specific standard. Na? Similarly, insurance company, if your client is from insurance sector, then your client will apply IND-AS 117. But right now, for insurance companies, Indian accounting standards are not yet applicable. But IRDA it is in the news that they would announce and IND-AS 117 and other IND-AS will be applicable for insurance companies from 2027. This is expected. And for financial instruments, you are bank or non-bank, you are earning interest income, then you apply IND-AS 109. Point number 4 is also important. This is important from auditor's point of view. Non-monetary exchange between entities in the same line of business. This exchange is to facilitate sales to customers or potential customers. Example is mentioned on the screen. Two oil companies exchanging oil to meet supply needs in different locations. Indian Oil is supplying to HPCL. Can Indian Oil record this revenue? No, because this revenue is not to the end customer. I'm selling to HPCL. HPCL sell to the end customer. HCL will recognize the revenue when it is selling to end customer. The goods sold by Indian Oil to HPCL will be returned back. HPCL will return that quantity back to Indian Oil. So this sales is not allowed because otherwise it would result in inflated sales. In this case, if this sale is allowed, what will happen? Two competitors will sell to each other and then they will continue to inflate their sales. Inflating sales is good for companies. You know that when startup culture was not there, I was under the impression that profit is more important than revenue. But startup culture has changed everything. Many startups are loss-making companies, but their valuation is very high. The reason is not profit because profit is not there. So high valuation is a reason of high revenue. So they are interested in recording their revenue. If this is allowed, then this would be a tool. Flipkart would sell to Amazon, Amazon would sell to Flipkart, they will continue to inflate their sales. This is not allowed. But it doesn't mean that Times of India selling slot to Hindustan Times or Hindustan Times, and in return, Hindustan Times is selling to Times of India. They cannot recognize the revenue. They are consuming it. In that case, they are becoming consumer. But the example which we are taking, Indian Oil and HPCL, they are not consuming it. They are selling to the end customer. So when we are buying services from others as consumer, then we are allowed to recognize revenue. Look at the screen, 5 steps. I think many of you are aware about these 5 steps. Just one reading. I'm taking a pause here for 30 seconds. We'll discuss these steps one by one.
Sir, queries will be taken up at the end or in between?
My recommendation is at end. Otherwise, questions, I think there may be
Yes,
many
sir.
questions.
That would be better.
Last 15 minutes or 30 minutes we can. Done. You can type done once you read all the 5 steps. Then we'll discuss all the 5 steps one by one. All of you. Revenue is one of the key reasons for many accounting frauds. So this standard is also the result of those accounting frauds. Done. Look at step number 1. If you compare it with old accounting standards, many of you are aware about old accounting standard also. Contract was there. Without contract, how we can recognize revenue? But within this contract definition, they have kept some of the key requirements. What are those requirements? Number 1, approved, nothing technical. Contract should be approved by all the parties. That is common sense. Rights identifiable, very simple common sense. It will be there in all the contract. Payment terms identifiable, very simple. Commercial substance, very simple. This is important. This is new point. Collectability, probable. If you are selling goods to a company which has very bad payment history, you know that if I'm selling something to company X, I may not be able to recover 100%. I may be able to recover only 70%. And you know it from the past dealing with that customer, or maybe some new development, maybe very poor credit rating, but you are doing business. In this case, your revenue will be only the amount which you expect that I will be able to collect. If the sales, as per agreement, the sales value is 100, but if you are of the view that I will be able to collect only 70, your revenue will be only 70. You cannot recognize revenue 100. Think about rebate, concessions, discount, even discount also. You are selling something for 100 and you have given the option to make payment within 30 days. Then 10% discount will be applicable. Shall I recognize revenue 100 or 90? You will make an assessment. These standards are principle based standards. Standards, IFRS or Indian accounting standards are not rule based. These are principle based, where many things are left up to the management judgment. You tell me, if you feel that my customer will pay me within 30 days and I will get only 90, then recognize 90. But if you feel that I will get after 30 days, then recognize 100. IFRS and IND-AS are assuming that management is honest. But then ICAI has given accountability to auditors. Then auditors will look for the behavior, na, that every reporting date they are recognizing 100 revenue, but they are getting 90. Then how they will be, the management will be able to convince auditors that my revenue, I recognize 100, but every time I'm recognizing 100, but I'm getting 90, then I'm doing revenue reversal. Once it is okay, twice it is okay, but every day I'm doing it, I'm reversing the revenue. Then there is something wrong with the management judgment also. Auditor can ask for justification. Step number 2, PO, performance obligation. What you are selling? Are you selling television? Are you selling laptop? Are you selling oil? Are you selling consulting services, audit services, accounting services, payroll services, security services? The things which you are selling as per agreement is your performance obligation. In step number 2, you should have clarity what I'm selling before recognizing revenue. And performance obligation can be of two types. It can be distinct, it can be not distinct. Distinct means these are separately identifiable. Very simple example, you are buying a car with extended warranty. These are two distinct performance obligation. Car is distinct from extended warranty. Another example, you are buying laptop with camera, with webcam. Laptop is performance obligation number 1 and camera is performance obligation number 2. There are two distinct performance obligations which are separately identifiable. But there are some examples where you cannot segregate two or more performance obligation. You are buying a laptop which comes with basic operating system, you know. Now basic operating system is very much integral part of the laptop. There is no functionality of laptop without that basic operating system. It is so integral part. It is, they are made for each other, you know. You cannot segregate them. If you segregate them, they will lose their laptop will lose its identity. These are not distinct performance obligation. Washing machine with software, if you segregate software, washing machine would lose its identity. If you talk about this building, you can see window. This window is also one of the performance obligation. If you segregate window from this building, what is the meaning of this building without window? This window is so deep part of this building, you cannot segregate it. These are not distinct performance obligation. You know why this is important? Because if performance obligations are not distinct, then you will be recognizing only one revenue. But if these are distinct, you will be recognizing revenue separately. For example, laptop and webcam. You are selling both of the items together, but you will be recognizing two revenues separately for laptop and separately for webcam. Car with extended warranty. Your revenue from car will be separate, revenue from extended warranty will be separate. Why this is important? Because car revenue you will recognize today at the point of time when you are delivering the car keys. But extended warranty, it depends on the timeline. If the extended warranty is extending for third, fourth, and fifth year, even if you are receiving payment in advance, the revenue from extended warranty would be recognized in year 3, 4, 5. You can see the timing. That will be recognized over time, over third, fourth, and fifth year. That is why while identifying performance obligation, you also need to identify whether these are distinct performance obligation or not distinct. I have many examples for you. If you look at the screen, example number one, we already discussed automotive. If you are working with IT sector, then your SaaS subscription and implementation, these two can be distinct performance obligation. If you are working into outsourcing business, in outsourcing business, for example, payroll services or audit services, or maybe consulting work. Suppose you got assignment from your client where you are going to work for 3 months, and out of these 3 months, uh, 1 month is falling in the next financial year, and 2 months are falling in the current financial year. Then your revenue would be spread over 2 financial years. 2 months revenue will be in the current year, and 1 month revenue will be in the next year. So even if your pattern of providing consulting services is same, every day you are providing similar kind of consulting services. Or another example, payroll services. Another example, security services. Another example, housekeeping services. For example, you are SIS company, which is into security services. For example, you are HGS, Hinduja Global Solution, which is into payroll management services. These are also by default falling into distinct performance obligation. Each day is distinct. Every day is distinct. Telecom sector. Sometimes telecom companies are launching a scheme. You buy a handset, then you will get 12 months subscription free. But you know, nothing is free in this world. When you are making payment to telecom company, you are making payment for both handset and 12-month subscription. And these are two distinct performance obligation. Handset revenue, company will recognize at the point of time on delivery, but subscription revenue will be recognized over time. Airlines, you are buying ticket and then you are getting certain points. You call it loyalty points. These are two distinct performance obligations. Nothing is free. When you are getting points for free, the value, the price you already have paid when you purchase the ticket. So these are two distinct performance obligation. Some examples of not distinct. IT. You are Infosys. You are providing a customized software with installation and integration and testing. There is high level of integration where you cannot segregate installation, testing, integration from the software. They are so deep components of one element or one performance obligation where you are not in a position to segregate them. Again, it is management judgment. I'm not saying that always this will be the case. Some of the software and installation can be segregate also, and some of the software and installation can be integral part also. You need to see whether high level of customization is required. If high level of customization is required, then most likely these will be not distinct performance obligation. But if customization is not that deep, then these can be distinct performance obligation also. Here, auditor's role will be very important. In these cases, where the things are not very clear, standard has given guidance, the rest of the things will come from your judgment, from your experience of doing audit of different companies, from your experience of doing accounting work for different companies. EPC contract. engineering, procurement, and construction. You will be buying raw material, and then you will be processing it, labor, material, overheads. So many things you are doing together. Designing, engineering, procurement, construction. These are so integral part of one performance obligation. You cannot segregate it. How you can segregate bricks from cement? How you can segregate labor from material? How you can segregate overheads from labor and material? Not possible. Then they will become one performance obligation. Step number 3, determine the transaction price. Selling price. In simple words, transaction price means selling price. What is your selling price? What you expect to receive? 100, 90, 80, 110. Is it fixed or is it variable? Is it adjusted for discount, rebate, penalty? Yes. So your transaction price will be net of discount, rebate, penalty. Earlier in the old accounting standard, we were recognizing revenue of 100. Then we were creating provision for discount, provision for rebate, provision for penalty. Profit will be same. Now we are recognizing net 90. In both of the cases, profit will be same. But in one case, your revenue is inflated. More the revenue, more the valuation. But if it is not true, you will not get true valuation. That is the problem. You are selling something today, but you will receive payment beyond normal credit period. Your normal credit period is 6 months. But you said that you can pay me after 3 years. Then your revenue is not future value. Then your revenue is present value. So this IFRS and Indian accounting standards, they are using the concept of present value very beautifully. The present value concept is applicable in almost all the accounting standard, except for IND-AS 12 income taxes. Income tax doesn't allow to calculate present value, but rest of the accounting standard, present value will be very important. You are selling something today, payment will come after normal credit period. Chances are very high you will be compensated by time value of money also, na? If you are selling something, ideally you should get your money within normal credit period. Suppose within normal credit period you expect 1 lakh rupees, but that customer will pay you after 3 years. Then you will not accept 1 lakh. You will ask to pay 1,50,000 because 50,000 is time value of money. So after 3 years, you will receive 1,50,000. Now the question is that shall I record my revenue at 1,50,000 future value or present value? And you have answer to this question. My revenue is not 150. My revenue is 1 lakh present value. But after 3 years, you will receive 150. Your trade receivables, your revenue is 1 lakh. Your trade receivable is 1 lakh, but you will receive 150. Then 50,000 you will recognize as finance income over 3 years period of time. You have to increase your trade receivables. You have to increase your trade receivables by recognizing finance income. So that finance income is not IND-AS 115 revenue. That finance income is IND-AS 109 interest income. So your IND-AS 115 revenue is only 100. Rest of the amount is IND-AS 109 finance income. Non-cash consideration. You are exchanging your old car with new car. Value of old car is 2 lakh and value of new car is 10 lakh. You pay 8 lakh rupees. Now my revenue should be 8 lakh or 10 lakh. My revenue is 10 lakh, na, fair value. What is the value of new car which I am selling? 10 lakh. So my revenue is 10 lakh. But how much I am receiving? 8 lakh. My bank account will be 8 lakh. I will also recognize old car. Old car debit 2 lakh. Bank debit 8 lakh. Revenue is 10 lakh. So this standard is about fair valuation. Everything should be at fair value. My old car should be at fair value 2 lakh. My revenue should be at fair value, which is 10 lakh. And net amount I'm receiving in cash. Talking about fixed and variable consideration. There are many examples of variable consideration. For example, penalty. You are Brookfield or you are L&T. You are constructing a road from Bombay to Pune, and the target is 3 years, and you will get 100 crore rupees. If you complete it early, maybe before 3 years, then you will get 5 crore rupees incentive. But if you delay it, then there is a penalty of 10 crore rupees. Now there are three chances. Either you will get 100 crore, no incentive, no penalty, or you will get 105 crore if you complete it early, or you will get 90 crore if there is a delay. You have completed 50% of the work in the first year. You are going to recognize 50% of the revenue, but 50% of what? 90 crore, 95 crore, uh, 90 crore, 100 crore, or 105. Standard says if you are highly confident, your confidence, your management judgment will be very important. If it is highly probable, maybe more than 90% chances that you will get 110, then go with 110 or 105. Incentive is variable consideration. Penalty is variable consideration. Fixed component is how much? 90. 90 crore is sure. 90 crore is 100% you will get, whether there is a delay or there is early completion. So 90 crore is your fixed consideration. 50%, if you are doing 50% of 90 crore, no auditor will ask any question because standard is conservative. Standard is saying that fixed component revenue recognition, we don't have any problem. But if you're L&T, you are very good company. You have very good track record. You have best of the quality engineers and other staff who can deliver it early and which you can justify. Then you can recognize revenue on the basis of 105 crore also. But you need to justify, you need to convince the auditors. But if you are a new company and you do not have any experience, then auditors will not allow you to recognize revenue on 105. Or even if you are old company and you have a track record that you never completed project on time, then also auditors will not allow you to recognize revenue on 105. To recognize revenue of variable consideration, which is 15 crore. So 15 crore is variable consideration. If you want to recognize revenue of variable consideration also, then you need to apply the judgment in such a way so that it should not result in revenue reversal. Because if you recognize revenue of 15 crore also, and tomorrow if you do not get that incentive, you will be doing revenue reversal. That is not the good position. In that case, the image of the company in the eyes of auditors, in the eyes of shareholders, would be compromised. That should not happen. Jewar Airport. Jewar Airport, December is the launch date. Its deadline is already over. One Zurich company is constructing it, and they are already paying 10 lakh rupees per day penalty. They are also applying IFRS 15. They are also recognizing revenue over time because it is EPC. Their performance obligation is getting satisfied over time. 90% of the work, 95% of the work is already over. Do you think they are recognizing revenue? They recognize revenue of 90%, 95% of 100% of the contract price? No. Penalty amount they have reduced. 10 lakh rupees penalty every day they are paying, which has impacted their revenue. So penalty will reduce revenue. You cannot recognize full revenue by creating provision for penalty. This is not allowed. Examples of transaction price. You keep answering some of the questions. What would be your revenue if you have given option to return? You are selling goods worth 100, out of which you expect that the customer would return items worth 40. Your revenue should be 100 or 60. What is your sales? 100. And what you expect? you expect that out of 100, goods worth 40 would be returned. So your revenue should be 100 or 60. Very good. The right answer is 60. And who will recognize inventory against 40 items? It is not just about this standard is not just about revenue. You need to think about inventory also. The moment you recognize revenue, you also recognize related cost of sales. Are you going to recognize cost of sale against 40 in profit and loss? Or will you be taking it as inventory in your balance sheet? Your cost of sales would be for 100% of the items or only 60% of the items? Yes. The right answer is your cost of sales will also be for 60% of the items. Against 40% of the items which are expected to be returned, these will appear in your balance sheet as inventory. Even if this inventory is not in your hands, this inventory is in the hands of customer because you did not recognize revenue with the expectation that customer would return these items. Inventory will be in your balance sheet. You will give disclosure in the notes. And also, you may be thinking that while returning, some of the goods may get damaged. That damage or cost of rectification will be reduced. If you expect goods to be returned, reduce the damage part, reduce the cost of rectification. But inventory will be in your balance sheet. Similarly, revenue will be net of discount. Concession will also be reduced. Rebate will also be reduced. Return will be reduced. Early completion bonus and penalty, these are variable consideration. Management judgment will be very important. These examples covered earlier. Some more examples. A real estate developer. Non-cash examples we covered earlier. A real estate will recognize DLF. If I show you annual report of DLF, you can see that company is recognizing revenue over time. As and when performance obligation is satisfied. You have booked a flat, you pay 10%. That 10% is not company's revenue. You paid another 10%, that is also not revenue. You paid 90%, that is also not revenue. Where that money is going? If 90% is not revenue, where it goes? It is going to the balance sheet as liability. They call it deferred revenue. They call it contract liability. This is big change. And some interest calculation will also be done, because in this case you have paid 90% to the company. That is a kind of financing arrangement. Company has taken loan from you. They have kept it under deferred revenue, but it is a kind of deferred revenue. It's a kind of loan on which finance cost will also be calculated. Some more examples. This example we already covered. If I'm selling something today and payment will come after 3 years, then my revenue will be at present value. And one more thing, if you do not know what is your normal credit period, for example, your client is saying that I don't know what is my normal credit period, I have different credit period for different customer, then standard say that you can assume 12 months as your normal credit period. It means if the payment is deferred beyond 12 months, then you can calculate, then you need to calculate present value to recognize revenue. Even for service companies also, if the payment is deferred, present value concept will be applied not only for manufacturing company, but for service company also. Even for construction of road, time value concept will be applicable. 1 year is practical expedient. It means no need to calculate present value if the payment is deferred only up to 1 year. And that practical expedient is applicable only when you don't know what is your normal credit period, or when there is no financing element. Step number 4. Step number 4 is allocation. This step will be applicable only when there are two or more than two distinct performance obligation. If there is only one performance obligation, or all performance obligations are not distinct, then step number 4 will not be applicable. You are selling car with extended warranty, then step number 4 will be applicable, because you are receiving one price and you are selling two items. Ticket with loyalty point. You are receiving one payment, 5,000 rupees from Delhi to Bombay. But you are selling two things. You are selling ticket, you are selling that credit points also, which customer can redeem at a future date. So this step will be applicable for airlines. This step will be applicable when we are selling two or more items. This step will be applicable when you are constructing a building, but you are also supplying furniture, air conditioner, etc. More than one performance obligation, this step will be applicable. 5,000 rupees you paid to Air India, but you are getting two items, ticket and points. So 5,000 rupees will be allocated to ticket and points in the ratio of their standalone selling price. What is the meaning of standalone selling price? The price which I normally charge when I sell tickets separately, when I sell points separately. You can buy points also. If you go to Air India website, you can buy their points. It means they are selling points separately. Similarly, you are buying laptop with Windows, MS Office. So MS Office is distinct performance obligation and laptop is distinct. You paid 90,000 rupees to the company. Company will recognize two revenues separately for laptop, separately for MS Office. That 90,000 will be allocated in the standalone selling price of laptop and software. What is the standalone selling price? It is the price which we are charging separately when I'm selling these items separately in the market. Another example, mobile handset data plan. The one price which you paid to the company, you paid only one price. With company saying that you buy a handset, 12 months subscription free. Company is not even telling you how much I'm charging for data plan. Company is saying that I'm selling you only handset, 40,000 rupees. But for accounting purpose, company will do calculation. 40,000 will be allocated between handset and data plan. And then revenue will be recognized. You know why this is important? Because handset revenue I'm going to recognize at the point of time today. But subscription data plan, I'm going to recognize over 12 months period of time. What is SSP? The price which we would be charging by selling these goods and services separately. There are two approaches. The preferable approach is observable price. It means it is the actual price which you are actually charging by selling these goods separately to the customer. For example, laptop you are selling for 75 and software you are selling for 15. So 75 and 15, that is the standalone selling price, which is observable. But sometimes, for example, you are selling air conditioner with installation. You are Carrier Air Conditioning Company, Gurgaon, and you got a contract from a shopping mall where you are going to install centralized air conditioner, and contract price is 5 crore rupees. By charging 5 crore rupees, you are doing two things. You will supply equipment, air conditioner, and you are going to do installation. To suppose these are two distinct performance obligations, and you are saying that I do not sell installation separately. I sell installation only to those customers, those who are buying AC from me. I do not have observable price. Then standard is saying, relax. I have different techniques for you. You can apply estimation method. In the estimation method, first preference is adjusted market assessment. You are not selling installation separately, but Voltas air conditioning, they are selling installation separately. You check with them, your competition. You ask them, you check with them how much money they would charge for similar type of installation. Because you are different from them, you need to make some adjustments because your scope may be different, but you will get some idea. This is known as adjusted market assessment. But if you are saying that I inquired from Voltas, I acquired from Whirlpool, I acquired from Samsung, they are also not doing this business separately. So this is also not available. Then you can apply second approach, expected cost plus margin method. You know how much cost you would be incurring for installation and equipment. Cost data would be available with you. No, you cannot say that I don't know cost. You have costing department, you have cost accountants working with you, and you know what is the material labor overhead you have incurred. You calculate cost separately for equipment, separately for installation, and then you add the appropriate markup to determine the standalone selling price. But if this is not also applicable, then you can apply residual approach. For example, you are selling three items separately: software license, installation, and AMC, annual maintenance contract. Three performance obligations you are selling, and three are distinct. License is distinct, installation is distinct, and AMC is distinct. Now you have confidence about standalone selling price of two items out of these three. You know with almost 100% accuracy that what should be the standalone selling price of AMC. And you also know what should be the standalone selling price of installation. But you do not have idea about what would be the standalone selling price for license. Because of the nature of this item, you do not know. Then you can calculate the value of license as a balancing figure. Suppose total standalone selling price is 100, out of which 10 is for AMC, 100 minus 10, 90, and 40 is for installation, 90 minus 40, 50. Then 50 is a residual approach, residual number. So this residual number can also be applied when there is high level of variability in determining the selling price. So this approach can also be applied on exception basis. First preference, this is given in terms of preference, that how we should apply these approaches. This is a very simple example, just 30 seconds. You just have a look at it. 99% you will be able to understand it. Done. Just look at one more example. This should also be very simple for all of you. Car revenue you will be recognizing at the point of time, point of sale, and extended warranty revenue will be recognized over the period of time. This example is also similar, software license with support. Step number 5 and last step. But do not assume that the standard would be over after completing step 5. They have given some additional guidance also. We are going to spend some time on those guidance also. If you remember, in the old accounting standard, we used to recognize revenue when risk and reward is transferred. You remember, na, risk and reward, very important word. But now the importance of risk and reward has reduced. Risk and reward is still there, but it is just one of the indicator among 4 or 5 indicators. Now, which word is important? Instead of using the word risk and reward, you will be using the word control. When control is transferred, you are selling something, and control is transferred, then only you can recognize revenue. Also, you also need to use one more word. When performance obligation is satisfied, this is a big change. Customer satisfaction has become very important, not the seller satisfaction. I'm selling something, I'm satisfied. No, no, no. This is not important. My customer is satisfied. This is more important. So, performance obligation satisfaction. You need to think from the customer point of view. When customer is happy, then only you can recognize revenue. It means when you have done your work, whatever you are supposed to do, when you have done your job, then only you can recognize revenue. If some parts are pending from your side, you cannot recognize revenue. And performance obligation can be satisfied either over time or at the point in time. Over time, they have given 1, 2, 3 conditions, not 3 conditions, 3 scenarios. If you are satisfying any of these 3 scenarios, you will be recognizing revenue over time. For example, customers simultaneously receive benefit. If I give you examples, customers simultaneously receive and consume benefits. Example is monthly payroll processing. Suppose you are having one assignment where your employee will do payroll processing for your client. And you have done 3 months of work in the current financial year. Then 3 months of work which you have done to the satisfaction of your client, that is your revenue. You are satisfying your performance obligation over time, because as and when you are working for your client is getting the benefit and consuming the benefit. Simultaneously, your client is receiving as well as consuming the benefits. This is scenario number 1. Scenario number 2, customer controls the asset. You are constructing a building on customer's land. For example, your company is a contractor. They construct building on the land owned by their customer. You have done 20% of the work. To whom this work belongs? Your customer, na? Whatever work you have done at customer site. That work which you have done is under the control of your customer. If you have done 20% of your work, you can recognize 20% of the revenue. 30% work, 30% revenue. So almost all the construction contracts, except for real estate, almost all the construction contracts, this will be the case when we are working on the site of customer. Third scenario, whatever work you have done, whatever asset you have created, that has no alternative use for you, and entity has enforceable right to payment. For example, you got order from your customer where you are going to manufacture furniture item for your customer. That is customized furniture. You are furniture manufacturing company and your customer gave you order where you are going to construct furniture. You got some advance payment and then you started to work. 50% of the work done. Now customer is saying that I don't want this. Possible, huh? You have done 50% of the work and customer is saying that I don't want this. Do you have any alternative to this work which you have done for customer? If answer is no, because this is highly customized. It has logo of customer. It has design approved by the customer, which has no value in the market. It means you do not have any alternative use for this work which you have done for your customer. That is condition number one. Number two, can you go to the court? Because customer has given you the order, 50% work you have done, and your customer has given you only 20% advance. Can you ask your customer to pay remaining 30%? If yes, if you can go to court and you can ask for 30% payment, in this case also, you can recognize revenue by using percentage of completion method. It means you will be recognizing revenue over the period of time. None of these three conditions real estate companies are fulfilling. You may have questions regarding this, which we will address at end of the session, but I'm repeating it once again. If you think about real estate company, none of these conditions, they are satisfying. Number one, if you look at point number one, you pay 10% advance and booked a flat, your dream house. Are you receiving benefit of the work, receiving and consuming the benefit? No, the flat is not handed over to you. Na? It is under construction. You are not receiving and consuming the benefit. Number two, are you controlling the asset? That flat is under your control? No, that flat is under control of DLF. Mm, 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 mm. Customer control. Customer is not controlling the asset. Point number three, asset has no alternative use and entity has no an enforceable. From point number three, 50% of the condition DLF can satisfy. They do not have alternative use. The flat which is booked by you, the flat which is booked by you, they do not have alternative use. Otherwise, they will become defaulter because they cannot sell that flat to anybody else. But based on experience, they do not have enforceable right to payment. 4% performance completed to date. The reason is whether project will be completed on time, to the satisfaction of customer. There are so many uncertain things, which are not in the control of DLF. We have seen in the past delay in completing the construction, some legal cases, some disputed cases. We cannot say that if 20% of the work completed by DLF, to that extent, performance obligation is satisfied by transfer of control of the asset. So when 20% of work, it means they are not providing you service. These are two different things. One is service and second is sale of goods. When I'm providing service to you, then most likely I will be recognizing revenue over time. If I have done 20% work for you, 20% is my revenue. 50% work for you, 50% is my revenue. But when I'm selling you goods, then most likely my revenue will be recognized at the point of time. So when you are booking a flat, it is not a service contract. It is sales contract. They are selling a particular unit to you. And that sale is not complete without getting the occupation certificate from the authorities. They cannot justify this that I have provided 50% service to you. No. On completion of the project, they will be handing over the keys of that property to you. Then only they will be able to justify that my performance obligation is satisfied. That is why DLF, Godrej Properties, and all other big players, they are recognizing revenue over time. And there are two methods for measuring progress. It's all about percentage of completion. If I have done 50% of my work, 50% is my revenue, but what is the base of that 50%? There are two methods, input method and output method. The DLF is using input method. If you see, the DLF is using cost method. Cost method means input method. If I'm going to spend 100 crore on a project and I have already incurred 50 crore rupees till date, so my percentage of completion is 50%. That is my cost incurred. But my what is my output? Sometimes input and output can be two different things. It may be possible that my output is only 40%. My input is 50% and output is 40%. Output is, in case of construction, most likely output would be certified by expert technical person, maybe architect or surveyor. They will certify. It may be based on milestones. It is happening with us also when we visit office. Sometimes it is happening that we have spent full day, our input is 8 hours, but output is zero. Sometimes we realize that we have got nothing. We have spent 8 hours in waste. But sometimes it is also happening that in the first 1 hour, we achieved every entire day's work. Input is only 1 hour and output is 8 hours. So input, output can be two different things. If you look at the screen, and it is not a it's not a matter of choice. It is not like that your company can choose any method of their choice. It depends on suitability. If input method is suitable, apply input method. If output method is suitable, apply output method. Some examples are mentioned on the screen. If you are building a dam, highway, developing and customizing ERP software, producing and customized producing a customized turbine for a power plant, R&D services, consulting, retainers, defense project. In these cases, input has clarity. Output may not have that clarity. So in these examples, output may not be directly measurable, but input is directly measurable. So input method is more suitable. Almost all the construction companies and real estate companies, uh, I think DL here I think I said something wrong. Uh, DLF is in most of the cases in real estate companies, DLF is using a point of time method. I think here I said otherwise. I'm correcting myself. The impact on real estate companies, most of the real estate companies now switched their method from percentage of completion method to point of time method. On almost all the real estate companies are recognizing revenue at the point of time. Because DLF is a big company, they have certain construction contracts also, which are not pure real estate contracts. In those construction contracts, they are using percentage of completion method also. But if I search point of time, you can see that if their revenue is 380, 160, all these numbers are in lakhs or crores, lakhs. All these numbers are in lakhs. If you look at this, out of 380, 160 lakhs, 359,404 worth of revenue is recognized at the point of time. And rest of the amount, small amount, insignificant amount, 20,755, they are recognizing over time. So I think I said it otherwise. I'm correcting it, repeating it once again. Almost all the real estate companies are now recognizing revenue at the point of time, while earlier in the old accounting standard, they were recognizing revenue over time. So in construction contract, real estate, the input method is more suitable, but in some of the cases where input is less clear and output is more crystal clear, then output method is more suitable. Some examples: electricity consumption, cloud company subscription model, or maybe some milestones are already defined, like 25% is the milestone one, 50% on pillars milestone two, 25% milestone on completion. So sometimes within the contract, within these contracts also, if milestone is clearly defined, then output method can also be suitable. And in some cases, input and output both can be same also. For example, consulting work based on hourly basis. If you worked 20 hours for your client, then what is this 20 hours? Is this input? Yes, this is your input. Is this output? Yes, this is output also. In consulting work, in payroll services, housekeeping, security, input and output can be same also. It is not always necessary that both will be two different things. Indicator of control transfer. This is also important. We discussed in step number 5, you will be recognizing revenue only when control is transferred by satisfying performance obligation, or performance obligation is satisfied by transfer of control. Present right to payment. You have right to receive payment. Customer has a legal title. Customer has physical possession. Customer has significant risk and reward. Customer accepted the asset. These are just indicators. These, do not assume that these are conditions. Practically, I have seen out of these 5 indicators, one indicator was missing. For example, in one case, I noticed legal title was not transferred to the customer, but then also company recognized revenue. Example is Maruti, Tata Motors, Mahindra. They recognize revenue on delivery of cars to their dealers. They do not transfer title to dealers. Title of the cars will be transferred to the end customer when they are selling to the end customer. But all of these automotive companies, 100% of them, the names which I took, they recognize revenue on delivery, not on sale to the end customer. Why? Because their terms and conditions are like that. Most of the companies are getting 50% advance payment and remaining 50% within 15 days. 100% payment they are getting within 15 days, and there is no return option. Dealer, if the dealer wants that I want to return, they cannot return it. They have to clear the invoices within 15 days. Whatever goods delivered by Mahindra to dealer, Hyundai to dealer, Tata to dealer, Tata Motor to dealer, Maruti to dealer, it's sale. It's sale. They recognize revenue. That's why sometimes in the economic times we read that during festival season they dump just to inflate their revenue. In the month of March, they dump vehicles at the dealer's place to inflate revenue. But they are satisfying the criteria. Na? That is the public media. That is the news. But the reality is that when they are dumping material, they are satisfying the criteria. Na? Goods would not be returned to them. They will be getting their money within 15 days. Then where is the problem? When control is transferred, even if legal title is not transferred, but then also control is transferred. In another example, I noticed physical delivery was not transferred. Physical delivery was not complete. Dabur. Dabur placed order for agricultural produce with the farmers, but they need that order they will place in advance or maybe during seasons. They will place order in advance, but they will take delivery after some time because they do not have space. They need to make payment in advance. Billing will be done, but they will ask the farmers, you keep the inventory with you. I will arrange for the pickup at a later date because I do not have space and I don't need this on urgent basis. I need all these items after 3 months. So physical delivery is pending, but farmers can recognize revenue. There are big farmers and there are some pharmaceutical companies and there are some plant manufacturers. So these types of transactions are happening. Publisher also, like Institute of Chartered Accountants of India, they place order for printing of books with some of the publishers, but they do not take delivery. They request them that delivery will take after 2 months, and that delivery you can do directly in Bombay, Chennai, Kolkata, etc. You don't need to send those physical books at the head office. You can deliver it at different locations because I need to deliver it in Bombay, Chennai, etc. In the regional offices. Now printing is done, billing is done, but delivery ICAI they have not taken. Now when publisher should recognize, printer should recognize revenue. The moment they complete their order, even if delivery is pending, they recognize revenue. So even if physical delivery is pending, they are recognizing revenue because they have fulfilled the rest of the criteria. Even if one criteria is not fulfilled, then also they have recognized revenue. Real estate, they will recognize revenue only when the flat is handed over at the point of time. Telecom, revenue is overtime. Aircraft construction, most likely it's a normal EPC type of contract, revenue will be recognized over time. Retail sale, mostly revenue will be recognized at the point of time. Contract cost under IND-AS 115. As we discussed initially, this standard deals not just with revenue, this also deals with cost. Two types of cost: incremental cost of obtaining a contract and cost to fulfill a contract. These are new things which were not there in the old accounting standard. For example, you won a contract or you got a very good sales order, but you are paying commission. That order would be executed over 3 years period of time. So it means you are going to recognize revenue over 3 years period of time, but you have paid huge commission, sales commission. Earlier, that sales commission was going to profit and loss. So there was a mismatch between revenue and related expenses. Revenue was getting recognized over 3 years period of time, but sales commission was going to the P&L upfront. So there was a mismatch. Now, what you can do, if it is directly attributable, if that sales commission is incremental cost of obtaining a contract, if you can satisfy this criteria, then this commission will be capitalized in the balance sheet and it will be amortized in the profit and loss as and when you are recognizing related revenue. Airtel, when they install those digital TV, they pay huge commission, and that commission they can capitalize if they are going to recognize the revenue over the period of time. Then that sales commission can be capitalized by Airtel if they are fulfilling this criteria. And similarly, cost to fulfill a contract. Service provider. If you are a service provider, then what is your cost? Earlier, it was covered under IS2 inventory standard, but now that paragraph 19 has been deleted. If you look at IS2, one paragraph about inventory of service provider was there, but now after IND-AS 115, that paragraph 19 has been deleted. Now the cost of service provider is covered under IND-AS 115. If you are a service provider, then whatever time and other costs you have incurred to provide services to your client, that can be capitalized as WIP, work in progress. That will also be capitalized, and that will be amortized to the P&L as cost of sales as and when related revenue is recognized. And one more thing, no need to capitalize cost to obtain a contract if it is short-term contract. If in any case you are going to recognize revenue within 12 months, then you have option not to capitalize that cost to obtain a contract. For example, sales commission. If the revenue will be recognized within 12 months, then the sales commission, no need to capitalize. It can be taken directly to the profit and loss. So sales commission, mobilization cost, and abnormal losses. If we have incurred abnormal losses, that can never be capitalized. One more thing, this standard will have some impact on balance sheet also in the form of trade receivables, contract assets, and contract liabilities. Earlier in the old accounting standard, the concept of contract asset was not there. It is a new concept. Earlier, we used to see only trade receivables, but now some companies are showing contract asset also. If I show you Infosys annual report, or maybe Infosys annual report, if I type contract asset, you can see they have recognized contract asset in their balance sheet. How contract asset is different from trade receivable? You are a finance professional. You should have 100% clarity. When you are reading a balance sheet, you should know what is the main difference between trade receivable and contract assets. Trade receivable is your right to receive payment. When you have satisfied performance obligation and recognize revenue, you call it trade receivable. But contract asset is also same thing. You also, in case of contract asset also, you have right to payment. In both of the cases, whether it is trade receivable or it is contract asset, in both of the cases, one thing is common, or even two things are common. Number one, you have recognized revenue in both of the cases. Sometimes you call it trade receivables, pending payment. So pending payment is trade receivable, or sometimes you call it contract asset. That is common point number one. Common point number two is both are assets. Both are right to receive payment. In both of the cases, you are waiting for your money. But trade receivable is your unconditional right to receive payment. And contract asset is your conditional right to receive payment. You have done your work. You are just waiting for your time, for your money. Only passage of time is required. You have given 3 months credit period. You are waiting for 3 months to pass. Then you will get your money. You call it trade receivable. But here, not just passage of time. You need to fulfill certain conditions also. For example, you have done 40% of the work, but payment will be released only upon completing 50% of the work. Even if you have done 40% of the work, your performance obligation satisfied to the extent of 40%, your revenue is 40%, but you cannot call it trade receivable because you need to achieve the milestone. Without achieving this milestone, you cannot take debit to trade receivable. You will take debit to contract assets. So when you read balance sheet of company, trade receivable means I'm just waiting for my money, nothing else. Contract assets, I'm waiting for my money, plus I need to achieve certain milestones also. This is conditional right. So trade receivable gives you more confidence. Contract asset is giving you less confidence because you need to do something more also to get this money. Contract liability is not a new thing, only name is a new thing. Earlier, we used to call it deferred revenue. Deferred revenue, income received in advance, contract liability, unearned revenue. These are different names, but the meaning is same. Here, what has happened? Either we have received money in advance, customer has paid money in advance, or we have done advance billing. So either you do advance billing or you receive payment in advance. In both of the cases, you recognize contract liability or you call it deferred revenue. Another name. Together, trade receivable, we have billed and we are just now waiting for cash. Contract asset, most of the cases, it is unbilled revenue. In most of the cases, not always, in most of the cases, contract asset is unbilled revenue because there are certain conditions to be satisfied. Contract liability, money received in advance, for which we haven't done the work. Now coming to the contract modification. I think this should be the last point which we should discuss. After contract modification, we can spend some time on question answers. Contract modification. It is a very common thing in practical scenario. You are a contractor working for your customer, and then your customer is modifying the contract. You are constructing a building. Customer is saying that we need to customize it in a different way. I want different design. I want different material. I want another floor. Earlier, the contract was for 10 floors. Now you need to add 2 more floors. I need parking at a different size, different location. I need club area. I need cafeteria. I need that color. I need this quality. Modification is very common thing. If you have constructed your house, you know that. How you modified it at multiple times during the construction phase. Practically also it can happen. You also call it contract amendment, variation, change order. Either you are changing the scope, price, etc. IND-AS 115 is providing 3 approaches, 3 treatments. In one approach, modification will be treated as completely separate contract. Whatever modification you are bringing as customer, I will treat it as a separate contract. It means these two things will not be mixed together. Whatever I am doing it till now, that is separate. Whatever you want me to do something new, that is separate. Second, modification. In this modification, I will terminate old contract and I will create a new contract. And I will do prospect. Whatever I have done in accounting, that is fine. Whatever I have done, whatever performance obligation I have satisfied and recognized revenue, that is gone. But for remaining performance obligation plus modification will be combined together and accounting will be done prospectively. Third, I will be doing cumulative catch up, retrospective adjustment. It means I will be doing retrospective calculation. Whatever I have done, that will also be taken into consideration. Whatever I am going to do in future, both will be mixed together and we will recognize revenue in a different way. So three approaches are there. Approach one, you need to satisfy two conditions if you want to treat modification as a separate contract. Condition number one, there is an increase in scope. 10 floors I already have constructed. You want me to construct 2 more floors. So those 2 floors is what increase in scope, which is distinct from the previous 10 floors. Second condition, price increase, which represent standalone selling price. By increasing the scope, by constructing two more floors, the price which I will charge from you, that will be the standalone selling price. I will not be getting less. I will not be getting more. If I'm getting less, it means my previous contract was not fair. If I'm getting more, then also my previous contract was not fair. Then I cannot treat it as a separate contract. Example, software company sells a license for 10 lakh rupees. Later, customer adds another independent module for 3 lakh. Now, whatever I have done or doing for 10 lakh, that will be done separately, and accounting for 3 lakh will be done separately because I'm satisfying both of the conditions. Number one, I'm by adding independent module, I am increasing the scope, and this 3 lakh is also standalone selling price. Both of the conditions satisfied. 3 lakh revenue will be recognized separately. It will be treated as a new contract. Now coming to the prospective adjustments, we'll understand with the help of example. And here, what is the condition? Whatever scope has been increased, that is distinct, but price is not standalone. For example, I am constructing 10 houses for 10 crore, so 1 crore each. And now I am going to add 2 more houses, but I will charge only 1 crore. Ideally, I should be charging 1 crore plus 1 crore, 2 crore for 2 houses, but I'm charging 1 crore. It means this 1 crore is not standalone selling price. Here, if my 10 crore worth of revenue is pending and 1 crore is increase in the scope, I will be combining both of the contract together. So 10 crore plus 1 crore, total contract price will be combined together, 11 crore divided by 12 houses. So that will be my average revenue per house, which I'm going to recognize with prospective date. So no retrospective adjustment, only prospective adjustment will be done. Third, retrospective. If the increase in the scope is not distinct, for example, EPC contract, building has a specialized plant, single performance obligation. Contract modified to include extra customized features, design change, that is not a distinct performance obligation. In the previous two examples, the increase in the scope was a distinct performance obligation, but now increase in the scope is not distinct performance obligation. Now, what we need to do in this case? In this case, the original contract plus modification will be combined together, and then revised calculation will be done. If you look at the screen, here original contract price is 100 crore, estimate cost is 80 crore, cost incurred till date is 40 crore, percentage of completion is 50%, 40 crore divided by 80 crore, 50%. Revenue already recognized 50 crore, 50% of 100 crore, and cost recognized is 50% of 80 crore, 40 crore. My profit is 10 crore. That is what we have already done. But now midway, customer request extra customized features. Now what is happening? Due to modification, you will be charging 20 crore more and the cost will be 16 crore. Revised price will be 100 plus 20, 120 crore, because we are combining original contract plus modification together, because the increase in the scope is not distinct performance obligation. We need to combine both, and then we need to figure out the combined price, which is 120 crore. And what is cost? Combined cost is 80 plus 16, 96. And then we need to compute the new percentage of completion. 40 crore is the cost which you have incurred till date, divide by 96 crore, 41.7% is the percentage of completion. And your cumulative revenue will be 120 crore into 41.7, 50 crore. And already recognized revenue is 50 crore. Now you will not be recognizing any revenue, even if you have done 41.7% of the work. Earlier, by completing 50% of the work, your revenue was 50 crore. But now by completing 41.7%, your revenue is still the same. That is what we are doing. We are doing this with retrospective impact. And the rest of the things are simple. In 2 minutes, if I revise what we covered so far, we covered IND-AS 115. We discussed that there are so many accounting standards. When IND-AS 115 was not there, there were two accounting standards and many appendices which were talking about revenue recognition. But now from 1st April 2018, we have only single revenue recognition criteria guided by IND-AS 115, which is based on 5 steps model. Step number 1 is contract, 2 is performance obligation, 3 is transaction price, 4 is allocation, and 5 is revenue recognition. In the contract definition, the most important thing is collection should be probable, without which we cannot recognize revenue. Performance obligation, we understood it can be distinct, it can be not distinct. This is important because if it is distinct performance obligation, revenue will be recognized separately for each distinct performance obligation. Third is transaction price. It can be fixed, it can be variable. Variable transaction price, revenue will be recognized only when it is highly probable that we will receive it. If due to penalty, we'll get less money, then we should not recognize revenue if we expect that penalty would be there. Similarly, we should ignore incentive also if we are not confident that we will be getting that incentive. And similarly, all variable consideration you should ignore. I'm saying it frankly. Practically, you should ignore all the variable consideration from revenue recognition unless you have high level of confidence or high probability that you will get it. Discount, rebate, incentive, return, expected return, you reduce from revenue. So you should present fair revenue. Fourth is allocation. Allocation will be applicable only when there are more than one distinct performance obligation. It will be allocated in the ratio standalone selling price. Standalone selling price is the price at which we are selling goods and services separately in the market. And finally, revenue recognition. In the recognized revenue when performance obligation is satisfied by transfer of control. And control has some indicators. Then we discussed contract modification. Sumit sir, are you there?
Yes, sir. Yes, sir. I'm there.
I think we can take questions now.
Yes, yes. I request all participants, and you have wonderfully covered, sir. So
Thank
it's
you,
a
sir.
great privilege. चैट बॉक्स पे पोस्ट करवाते जाएं या अनम्यूट करके दे कैन आस्क
अनम्यूट से तो मुझे लगता है टाइम फिर एक्सटेंड हो जाएगा
ज्यादा
if
लगे
you are
एक्सटेंड हो
comfortable.
जाएगा तो ठीक है नहीं नहीं डेफिनेटली डेफिनेटली participant please post your query and Hemant sir will take up and
I'm reading some of
respond
the
correctly.
questions. If I start from last, Manoj, retention money. So Manoj, in all cases, present value is mandatory when there is significant financing element. For example, retention money will be with you for 5 years. And most likely significant financing element will be there. In this case, Manoj, present value calculation will be required. Second question, Rahul, contract conditional and TR unconditional right. Yes, I think that is your observation, not the question. Jyoti, treatment of commission paid to the recruiting agent by the company. Recruiting agent by the company. Here, Jyoti, I think commission paid to the recruiting. Here, this is my operational and management expenses, O&M expenses. The commission which we discussed today, Jyoti, is connected with revenue. For example, you are paying sales commission. This commission is not sales commission, right? This is commission being paid to the recruiting agency. This is normal expenses which will be taken to the profit and loss as your expenses. You cannot capitalize it. Manish, what is the difference between point of time and period of time sales recognition? So Manish, example is there are two things, sales of goods and sale of service. Example is sale of goods, car. For example, Manish, you purchased a car, Scorpio, with extended warranty for 3 years. Now dealer, for sale of car, they will be recognizing revenue at the point of time when they hand over car key to you. So their performance obligation is satisfied when they handed over the car keys to you. But extended warranty, their performance obligation will be satisfied when extended warranty would be activated. That would be activated maybe in the third, fourth, and fifth year. So the money received against extended warranty would be recognized in third, fourth, and fifth year. So how to compute present value, that for which I think we need to use Excel file. If time permits, I will use it. Lakshmi, cost of sales will be considered for 60% of the item. Very good. I think that is the answer to the question. Contract is ready on 31st March 25, but sale will not create 31st March, then accrued income. Yes. So this is important question. Ashutosh is saying, I have done my work. My performance obligation is satisfied, but due to certain reasons, billing is not done. Can I recognize revenue? Yes, you can. Because Ashutosh, all the IFRS and IND-AS are following substance over form. If you have satisfied revenue recognition criteria, then one paper invoice which is not yet generated will not stop you from recognition of revenue. Certainly you can recognize revenue because you have satisfied performance obligation. Kuldeep, which IND-AS would be apply on business for renting of this is important. So Kuldeep, it will be IND-AS 116. DLF is applying IND-AS 116 for computing rental income. Anjani, what will be the treatment of unbilled revenue in books? So Anjani, here I'm assuming unbilled revenue, it means you have done your work, but you cannot get the money because you need to satisfy certain conditions. Here, Anjani, if I assume some conditions are yet to be satisfied, then this unbilled revenue will be contract assets. But Infosys has, if you look at, you all can refer Infosys annual report. Infosys has two types of contract assets. No, Infosys has two types of unbilled revenue. One unbilled revenue, which is conditional, they call it contract assets. And another unbilled revenue, which is unconditional, they call it trade receivable. So do not always assume that unbilled revenue is always contract asset. No, most of the cases that is the case. In most of the cases, unbilled revenue will be contract asset. That will be your observation. But what is the true concept? The true concept is not about billed revenue or unbilled revenue. Accounting standard is not talking about billed and unbilled revenue. Accounting standard is talking about conditional right and unconditional right. So conditional right, whether billed or unbilled, is contract asset. Unconditional right, whether billed or unbilled, is trade receivable. Manoj, in works contract, not real estate asset, real estate. If we are recognizing revenue on the basis of customer control the asset, there will not be any WIP inventory at. Uh, this is also good observation. So Manoj, suppose your output is 40% and input is 50%, and you are using output method. In output method, there will be WIP. How? Suppose your total contract price is 100. Suppose your total contract price is 100. And total estimate cost is 80. And your percentage of completion is 40%. And cost incurred till date is 40 crore. So Manoj, your cost incurred till date is 40 crore. So by using input method, your percentage of completion is 50%, right? Because out of 80 crore, you have spent 40 crore. So your percentage of completion using input method is 50%. But because you are using output method, how much cost you will recognize in profit and loss as cost of sale? 40% of 80, 32 crore. How much cost you have incurred? 40 crore. But how much you are recognizing in profit and loss as cost of sale? Only 32 crore. So 40 minus 32, 8 crore is WIP inventory in your balance sheet in this case. Very good. Rahul, how is variable consideration treated? Discount, rebate, incentive. So Rahul, apply management judgment. If you are of the view that discount, rebate, incentive would materialize, you reduce it from revenue. Suppose 100 is your revenue, but discount, etc. is 20. Discount, rebate, incentive is 20. So Rahul, my recommendation is you should recognize revenue only 80. It should be net of discount, rebate, etc. Hope this is fine, right? Adya, what about credit notes given to parties at end of the year over the various discount? Should we need to reverse the revenue in that case? Credit notes, yes, we need to reverse, but it depends. If there was error in the estimation, Adya, you gave credit note earlier, it means when you recognize revenue, you recognize 100% of the revenue. But later on, due to certain reasons, you gave credit notes. If there was error in the estimation, then you will be doing revenue reversal. Otherwise, you charge this amount in the profit and loss as expense. Because when you recognize revenue, if there was no error in the estimation, then no need to do revenue reversal. Then those discounts can be taken to the P&L as normal expense. This is change in accounting estimate. Sunny, we are selling 5 bouquet of services at one price of 1 year membership, fixed price 15,000. If not used by the customer, then amount is not refunded. How the direct revenue and cost should be? This is also important. You are charging 15,000 and selling 5 distinct performance obligations. Here, Sunny, I'm assuming 5 services are each distinct performance obligations. Even if these are non-refundable, you cannot recognize 15,000 revenue on day one. Do not assume that it is non-refundable. I should recognize revenue on day one. No, revenue is linked with performance obligation. The most likely in case of service contract, Sunny, most likely your revenue will be recognized over time because this is service contract. Mostly your performance obligation will be satisfied over time. As and when you are doing the work by using percentage completion, you will be recognizing revenue. Another example, airlines. In some cases, you book non-refundable ticket. Can airline book revenue when you book the ticket because it is non-refundable? No. They will be booking the revenue only on completion of journey. So completion of performance obligation is very important. Commercial substance, CAIND. So commercial substance means there should be value addition. For example, parent company is selling to subsidiary. Parent company will recognize revenue in its separate financial statements, and subsidiary company will recognize inventory in its separate financial statement. But when you consolidate, can you recognize this revenue from sale to subsidiary? Does it have any commercial substance at consolidation level? No. In consolidation, parent plus subsidiary will become one entity. You follow single entity concept where you cannot recognize revenue, which is intra-group transaction. Such transactions have no commercial substance. You cannot recognize revenue at consolidation level. Manoj, if any revenue like incentive is recognized after 2 years, then should we recognize same amount as inventory also? Most likely inventory you already have recognized as and when you recognize revenue. For getting incentive, are you incurring extra cost? Most likely no. Incentive is for early completion. Incentive is for doing your work perfectly. I don't think you are incurring some extra cost to get the incentive. That's why incentive is pure revenue, pure profit. But if you are saying that I'm incurring additional cost to get the revenue, the incentive, then additional cost will also be incurred as and when you are recognizing the revenue. That will happen in that case. Tarun, if service provider have taken advance for 1 year service, however, contract value subject to deduction of certain SLA TAT, which is not known as of now, then how we should recognize? If things are not known, then management estimate will play a very important role. Then you discuss with your auditor and CFO. Then you take conclusive stand that this is the most likely case, and accordingly you can recognize revenue. Rupesh, if everything is same, but percentage of completion 60% instead of 40%. Oh, that is most that is the I don't think this will happen. Actually, personally, it can happen. Sometimes your input is 40%, but output is 60%. Personally, I can imagine, Rupesh, you are achieving 100% of the output by spending only 50% of your input. But when you're constructing a building, chances are very low that your input is only 40% and output is 60%. I'm yet to see any contract where output is more and input is less. But theoretically, it is possible. Then we need to see how the things will be impacted. Will there be any negative WIP? That will not be the case. Then inventory will not be there in the balance sheet. Yes, Rahul, in that Rupesh, in that case, no inventory will be there in the balance sheet. So you can keep posting your questions. We still have time. Manoj, contract cost, commission paid to get the contract. Contract cost, commission paid to get the contract. If commission paid upfront and we are not, oh my God. So this commission you can capitalize only when there is 100% surety that you will get the contract. So Manoj, if you are not sure whether I will get the contract or not, then it is not fulfilling the definition of cost to obtain a contract. In that case, Manoj, entire commission will be taken to profit and loss. Another example, you are traveling, you are holding meetings so that you can get the contract, but you are not sure whether you will get the contract, then traveling cost, commission, other expenses which you incurred to get the contract, you cannot capitalize. Only those expenses can be capitalized which are giving you 100% contract with 100% surety. Right, Manoj? Sunny. What about corresponding cost in case of membership sold for 1 year if revenue recognized equally? So membership of what? Club membership, gym membership? Then we have O&M expenses, operation and management expenses, Sunny. Like you are paying salary, you are paying rent. Those monthly expenses you will record in your profit and loss in the normal course. And here, sometimes there can be huge profits, sometimes there can be losses. It's like that. 5 services combined as when you are saying distinct. So Sunny, in this case, when you are saying 5 distinct performance obligation, here I'm assuming that you can track their expenses also, which are directly attributable. If you are saying that I cannot track their expenses separately, then you cannot say that these are 5 distinct performance obligation. So you should have that inbuilt capability to track their expenses also. Otherwise, there would be mismatch. Then you will be treating all the performance obligation as single performance obligation. Right, Sunny? In the beginning, I think there were certain questions. If you still have those questions, you can post it in the chat box. Yes, Sunny, I think Sumit sir can do it.
Hello.
Yes, Sunny.
Sir, what I was asking is that we are selling bouquet of services,
Okay.
5 services over a
Okay.
period of 1 year.
Okay.
So 15,000 is the selling price.
Okay.
So what we are doing as of now, we are recognizing equally over the 12 months,
Okay.
15,000 divided by 12,
Okay.
that we are doing as of now.
Okay.
But we are confused about the corresponding direct cost,
Okay.
whether it should be also recognized equally or it should recognize depending upon when the invoice come from vendor.
What type of cost you are incurring? Any examples?
Uh, for example, we are giving golf.
You are giving?
Golf.
What is that? Can you repeat?
Golf. You play golf?
Golf.
Yes.
Okay. Okay. What cost you
So
are incurring here?
we are incurring the cost from the golf clubs.
Golf clubs.
Yes.
Okay.
So
You
we
pay
are selling.
fees?
Yes.
Fees to clubs.
Yes.
Okay. And that is monthly fixed fees?
No, that is depending on the usage. If the
Usage.
customer goes, then only golf club will charge us. Otherwise, they will not.
So then why you have confusion here?
Why we have, pardon?
Then why there is confusion that here you
The
are able to match cost with the
revenue
revenue,
we
right?
are revenue we are recognizing over a period of time equally, but the corresponding cost we are not recognizing equally. We are recognizing when the invoice come from vendor. So there is a mismatch to that extent between the revenue and the cost.
So what is your revenue model? You are receiving revenue on per usage basis, right?
No, we are in this case we are receiving the revenue once that membership is sold, and membership we are getting 15,000 for 1 year.
For 1 year. And expenses are per usage basis.
Yes.
So fees is annual, expenses are usage basis.
Yes.
And how many members you have?
More than 500.
So 500 into 15,000 is your revenue, which you are charging on equally, right?
Yeah, 15,000 will not come at for example, we are selling some 50 at 15 January, 15 February, 100 in March. So we are selling this membership over a period of time whenever the customer need the same.
And sometimes there are more number of members are using or no, more number of visits are there. Sometimes less number of
Yes,
visits are
yes,
there.
yes, yes.
Hmm, hmm. And there is a mismatch because sometimes expenses are more, sometimes expenses are less.
Yes.
Here, I think this is your business model. Here, we should not do straight lining of expenses. Revenue
Hmm.
straight lining is okay,
Hmm.
but expenses straight lining is not justified because
Okay.
expenses model is different. So sometimes
Right,
there can be more profit, sometimes can be less profit, but that is the nature of the business.
right.
This is justified. Whatever you are doing, I think is correct.
Oh,
Yeah.
okay. Thank you.
Thank you. Uh, Naresh, computation of present value. What rate? Good question. Present value calculation standard says you should take the incremental borrowing rate. For example, you have a contract with customer, you are selling a machine, payment will come after 3 years. It means indirectly you are funding your customers. You are selling machine today, value of machine is 5 crore. But instead of your customer, instead of taking loan from bank, customer is taking loan from you, right? So when you are deferring the payment for 3 years, indirectly you are acting like a bank for your customer. Now, how much interest you would charge by giving similar loan to the customer? If you charge 9%, if you charge 9%, then 9% will be applicable. So the rate as per IND-AS 115 will be different from company to company. That will be the applicable rate by doing similar type of transactions. It means if you give 3 years of loan in independent transaction without selling anything, how much interest you would charge, that interest rate would be applicable. Or you can apply incremental borrowing rate. This is similar to incremental borrowing rate. Or if that is not available, then you can check from the market. You can ask to the bank that if I take loan from you, how much interest you would charge. That rate can also be taken. Weighted average cost of capital will not be suitable because the weighted average cost of capital, we take cost of equity also. Here we should take cost of debt because this is pure debt financing. And any other pending question? So important is Maruti, Mahindra, Tata. They recognize revenue on delivery, not on end sale. Make My Trip, Ola, Uber, they recognize revenue on net basis, commission basis, not on gross basis. And presentation of financial statement, for presentation of financial statement also, new standard is coming up, IND-AS 118. ICAI has not yet issued it, but they will issue it. It is still in the draft position. They have already issued exposure draft for public comment. IND-AS 118 will change the presentation of financial statement completely, where within the profit and loss, you will be having three activities. The way you prepare cash flow statement of cash flow, similarly, you will be preparing your profit and loss by showing operating activity, investing activity, and financing activity. That new accounting standard is most likely will be applicable from 1st April 2027. Yes, Sumit sir. Are you there, sir?
Yes, Hemant sir. Wonderful presentation and wonderful coverage of the topics. So special thanks to you for your wonderful time and sparing your valuable time. And all the participants, we have learned a lot. And tomorrow schedule is 4 p.m. So keep in mind tomorrow session is 4 p.m. being a Sunday. So Hemanji, once again, I am at in the car, so not on my camera, but I can see you and your smiling face also. So special thanks to you, to each participant. Once again, thanks to each one of you. Thank you, sir. Thank you. Now it's
Thank you.
closing
Thank you.
time.
Thank you, everyone. Thank you.
Thank
Bye-bye.
you. Thank you. Bye.